Hey folks, welcome you all to a new video. This is CA Ganesh Bharadwaj. So in this video, we are going to discuss some case study based MCQs, right, that are present in your revision test paper and both the mock test papers MTP 1 and 2 of May 2024 exams pertaining to paper 6A financial management, right? So this is going to cover 15 marks in your upcoming exams. So now this is a must watch for sure because there is no other source for us to prepare the case study based MCQs. So for all the exams, for all the papers, right, be it Inter or CA final, right, so the only source of preparation for us with respect to case study based MCQs is the RTP and the two mock test paper series released by ICAI. So I thought, let me just discuss this so that out of this video, right, whatever we are discussing right now, maybe even out of 15 marks, if 8 to 10 marks even comes, then that is going to be a huge impact for us. Just imagine 8 out of the 50 mark FM component, that is about 16 to 20% is what we're talking about. Are you clear with this, guys? So now let's get started with the case study based MCQ. So first, let's pick the RTP. So this is your RTP for May 2024 exams, right? So now in this RTP, they have given one comprehensive case study based MCQ, right? And they have given this in the from the working capital management chapter. Now let's quickly get started. Admore LLP is a newly established startup dealing in the manufacture of a revolutionary product called as HDHMR, which is a substitute to conventional wood and plywood. It is an economical substitute for the manufacture of furniture and home furnishings. It has been asked by a venture capitalist for an estimate amount of funds required for setting up a plant and also the amount of circulating capital required. A consultant hired by the entity has advised the cost of setting up the plant would be 5 crores and it would require 1 year to make the plant operational, right? All the story and all is given, right? The anticipated revenue and associated cost number are as follows. So now we are more focused on the working capital part. Now, what are they saying? Units to be sold 3 lakh square meters per annum. So now in this particular question, 1 unit of measure, the unit of measure is 1 unit is nothing but 1 square meter. Are you clear with this, right? Square meter is nothing but 1 unit. It's a unit of measure for plywoods, it seems. I mean, the product as a substitute for plywoods. So they are planning to sell 3 lakh units. You keep it like that. The sale price per unit is going to be 1000 rupees. The raw material cost is going to be 200 rupees per unit. Labor cost 50 rupees per hour, and to produce 1 unit they need 3 labor hours, which means what is the labor cost per unit? 50 into 3, 150. Similarly, manufacturing overheads is 75 rupees per machine hour, and to produce every unit you need 2 machine hours. So what is the manufacturing overhead going to be? 75 into 2, 150 per unit. Next, the selling and credit administration overheads is going to be 250 rupees per unit. Now, being a new product in the industry, the firm will have to give longer credit period of 3 months to its customers. So now what they are saying, to their debtors, the credit period needs to be how much? 3 months. It will maintain a stock of raw material equal to 15% of annual consumption. So raw material is going to be how much? 15% of annual consumption is going to be the stock of raw material, right? Then, based on negotiation with creditors, the payment period has been agreed to be 1 month. So creditors for purchases is going to be 1 month credit period, right? And the entity will hold finished goods equal to 2 months of the units sold, right? So the FG stock is going to be what? 2 months of sales. Clear with this, guys? All these things you need to be having it in your mind, or maybe you can just jot it down like this so that it will be easy for you to attempt the answers. Like whatever they are asking us as questions, it will be easy for you to pick the right figures from. The entity will hold a finished stock of equal to 2 months of units to be sold. All other expenses are to be paid in 1 month arrears. So outstanding expenses. What expenses? All other expenses except material cost, right? So they are giving us a time period of how much? They are giving a time period of 1 month. Cash and bank balance required is 25 lakhs. Clear with this? This entire paragraph I have just broken up and I have just put it here. Clear with this, guys? So cash balance required is 25 lakhs. The entities also So next paragraph they are giving, the entity is also considering reduction in the working capital requirement by either of the two options. Option A, reduce the credit period to the customers by a month, which will lead to reduction of sales by 5%. Now what they are saying, so now working capital, right, they want to reduce. If they want to reduce the working capital requirement, there are two alternatives. Alternate one, you cut down the credit period by 1 month. Instead of giving 3 months, you now give only 2 months. Accordingly, your working capital requirement will reduce. But what is happening on the flip side? You will lose out on 5% of the sales. Clear with this? And option B, engaging a factor for managing the receivables who will charge a commission of 2% of the invoice value and will also advance 65% of receivables at the rate of 12% per annum. This is what they have given. This will lead to savings in admin and bad debts to the extent of 20 lakh and 60 lakh respectively. So if you go for factoring, what will happen? 65% of the receivable value will immediately be released, right? To that extent, you need not fund it. But what is the cost here you've got? You need to pay him 2% of invoice value and some 12% per annum is going to be what? That is going to be the amount of interest that you need to pay. But one more advantage is that you will save on all your credit administration and bad debts. 20 and 16 lakh, 36 lakh will also be a saving for you. Clear with this, guys? Two options are given. That is what is given in this paragraph. The entity is also considering funding a part of working capital by a bank loan. For this purpose, the bank has stipulated that it will grant 75% of the net current assets, means what? The working capital, current asset minus current liability, as advance against the working capital. The bank has quoted 16.5% rate of interest. Wait, with the condition of opening a current account with it, which will require 10% of the loan amount to be the minimum average balance. They are saying, I will give you the amount. How much amount I will give? 75% of your net working capital. But wait, one condition, you should always maintain in my bank account. How much? You should always maintain in my bank account 10% of whatever loan amount that I'm giving you. So technically speaking, the 16.5% actually funds only 90% of the component. They are saying we'll give you 100%, but you need to maintain 10% with us always, minimum. Right? Which means technically it funds only 90% of it. Are you clear with this? This is how you need to read the question. Now, you being a finance manager has been asked a few questions. First, let's quickly run through what are the questions asked. Based on that, we will frame the approach. First, the anticipated, calculate the profit before tax per annum. Nothing but you need to prepare a cost sheet and arrive at the operating profit. Next, estimated current assets requirement in the first year of operation, where data are calculated on cash cost basis. Clear with this, which means that data are valued at cost of sales. Next, the net working capital requirement for the first year, again we'll find that. Now annualize the percentage cost of the two options for reducing the working capital. Two options, one is by reducing your credit period and parallelly you lose out on 5% of the sale. The second one is going to be a factoring option. What is the annualized cost? And finally, what is the maximum permissible bank finance by the bank and the annualized percentage cost of the same? Now guys, this is not the theory portion, maximum permissible bank finance by RBI. No, that got omitted by institute, right? Ever since the new syllabus got introduced. Here they are asking, in this case, the question is said, they are saying 75% of the net working capital will be funded by me maximum. That they are asking specific to this question. Don't think that the Tandon committee maximum permissible bank finance, if you have already written in old syllabus, you have prepared under old syllabus, you might have, chances are you might have read this. So in the new syllabus, I told you it's all removed. It's not there, right? So it is removed only. Don't worry. This maximum permissible banking finance is not a theory concept, right? In this question, they are saying the banks will fund a maximum of so much. Based on that, they are asking. Clear with this, guys? These are all the questions that are being asked, which we need to answer. Now, first, what we need to do, first, let's prepare a cost sheet, because anyways, based on that only, we will also be able to prepare a statement of working capital estimates. Very simple, guys. Very, very simple. Now, first, what you need to do, the first and foremost important understanding is what is the number of units to be produced, right? Cost sheet, up to the cost of production, it is driven by the units produced. How many units to be produced? So 3 lakh units to be sold. No, wait, that is not my production. They have also given that they need to maintain 2 months equivalent stock of FG, correct? So opening stock is not there. So what you will do is, because they're starting this company for the first time, yes, it's a newly established startup. So there is no opening stock. Are you clear with this? Which means the first year production should be equal to the units sold plus units unsold. So now in a year, they are planning to sell how many units? 3 lakh. And what is going to be the number of units lying in my FG? 3 lakh into 2 divided by 12. That's going to be 50,000. So the production will be 3,50,000 units. Are you clear with this, guys? Look, this is what you first need to understand. So stock of FG in units, here square meter is units. 30 lakh into 2 by 12, that gives you 50,000, right? And the units sold is going to be 3 lakh. So basically, what's going to be your production? 3,50,000 units or square meters, whatever it is. Clear with this, guys? Now you have this. So what is going to be a raw material consumption value? So they have clearly given all the data. So raw material cost per unit is 200. So 3,50,000 into 200, 7 crore rupees. What is going to be your labor cost? Labor cost is going to be 50 per hour, and every unit requires 3 hours. 50 into 3, 150. So 150 rupees is per unit cost. So for 3,50,000 units, it's going to be 5,25,000. Similarly, what's going to be your production overheads? Production overheads is going to be 75 rupees per machine hour, and per unit I need 2 machine hours, which makes it 150 rupees per unit. 150 into 3,50,000, 5,25,000. So now, I'm sorry, 5 crore 25 lakhs. So this is your total cost of production. No opening and closing WAP and all are there. Right? So from this, add opening FG, nothing is there. Minus closing FG, yes. How many units? 50,000 units, each valued at 500 rupees only. So now you get your COGS. How many units am I selling? The cost of goods sold is going to be 3 lakh units. Each is valued at rupees 500. So it's going to be 15 crores. Clear with this, guys? It's pretty much direct and straightforward. Now they have given admin and selling expenses. Look at this. It's going to be 250 rupees per unit. Now you should know that the selling expenses are driven by the number of units sold only. I incur selling costs only for the units sold. Correct, guys? So here it's going to be what? 3 lakh units into 2 lakh into 250. That's going to be 7.5 crores. So what's going to be my cost of sales? For 3 lakh units which is being sold, my per unit cost is going to be 500 plus 250, 750, and the overall cost of sales is going to be 22.5 crores. Clear with this? And what's going to be my sales? They have given that the every unit being sold is being sold at a selling price of 1,000 rupees. So 3 lakh into 1,000, 30 crores is going to be my sales value. So sales minus cost of sales. Now I earn a profit of how much? 7 crore 50 lakhs. Are you clear with this? So a basic cost sheet, write this as nothing much to do with your FM. So this is the basic cost sheet, and from this only, this is the base for you to attempt all the other remaining part of the question. So now 7.5 crore is going to be your 7.5 crore, or in other words, if you want to express in lakhs, it's going to be 750 lakhs is going to be your profit before tax. Are you clear with this? So here it's going to be option number A, 750 lakhs. Next, what is the estimated current assets requirement for the first year? Prepare it based on cash cost basis. Now guys, it's very simple. What do we do now? What do we do now? Right? So first, stock of raw materials. How many stock of raw materials I need? Go read the question. That's why I have just written all these things here. Raw material is equivalent to, in every working capital cycle, I need to stock how much? 15% of my annual consumption. So what's my annual consumption here? What's my annual consumption here? The annual consumption is 7 crores. So 7 crores into 15%. So in every cycle, at any given point of time, I need to have 105 lakh rupees worth of raw material stock. Next, stock of FG. What have they given? Stock of FG is going to be 2 months stock of FG. Anyways, this has been valued here. How much is my FG value? FG value is going to be 50,000 into 500. It's going to be 2.5 crores. So every time at any given point of time, I need to maintain a stock of 2.5 crore or 250 lakhs. Next, debtors. Now, debtors. Presently, debtors are given 3 months credit period. Are you clear with this? So in a year, what is the total cost of sales? So the amount that gets blocked in my debtors is going to be my cost of sales, not the sale value, because profit doesn't get blocked here. In a year, what is the total cost of sales? 22,50,000. So here, 22,50,000 into 3 by 12, 3 months equivalent cost of sales is the amount that gets blocked in my debtors. That is going to be 5 crore 62 lakh and 50,000. And apart from that, the company is also required to maintain a cash balance of 25 lakhs. So the total current assets, add up all these things. You add up all these things, 105 lakhs, 250 lakhs, then you get 262.5 lakhs and 25 lakhs. You add it up, you get how much? This is going to be 562.5 lakhs and then 25 lakhs. You add all these things, you get how much, guys? You get 942.5 lakhs. Are you clear with this? So that is going to be your part 2. So that's going to be 9 crore 42 lakh and 50,000. Are you clear with this? So this is what they have mentioned as A. Then the next one. The net to working capital requirement for the first year of operation. Very simple. Now we have done the current assets. From that, you reduce the current liabilities, right? That option A, option B, we have not yet come to it. Wait, right? So how much is this? So till now, we have got this current assets. These are the figures already calculated by us. Now minus. Should I need to bring in this much amount of funds? No. Indirectly, my creditors and outstanding expenses are also funding me to some extent. Now remember, guys, creditors, they fund me not on consumption. They fund me for what? They fund me for purchases. So what is going to be my creditors purchase value? So that is going to be, so how much will I purchase? I don't have an opening stock of raw material because it's a new year. I mean, I've started my business for the very first time. So now my purchase is going to be total annual consumption plus the closing stock of raw material, right? Right, guys? Fine. So consumption in a year, how much is that going to be? How much is that going to be? Raw material consumption is 7 crores, right? And I have a closing stock of raw material. How much is that? The raw material value, raw material stock is going to be how much, guys? So that is going to be 105 lakhs or 1 crore and 5 lakh. Are you clear with this, guys? So I add up this. So this is going to be the total amount of purchases that I'm going to make in a year, correct? And these guys, the creditors, they are going to fund me to for how many months? For 1 month. So now the amount that gets funded by the creditors are going to be how much? So it's going to be 8 crores and 5 lakh for 1 year. For 1 month, how much is that going to be? So that's going to be 805 lakhs into 1 by 12. So now basically this amount, to this extent, my creditors are funding. Are you clear with this? Now, how about the other outstanding expenses? All other expenses are on credit. Now, what are the other expenses? Now, very simple. So remove material because that is being funded by my creditors. What are the other expenses? So labor cost 525 lakhs plus production overheads another 525 lakhs plus selling expenses 750 lakh, which means how much is this? 1800 lakh rupees. 1800 lakh rupees is the total amount of annual expenses other than raw material. Correct, guys? Right? Look at this, 1800 lakh rupees. This is the total expenses, and all other expenses are payable 1 month in arrears. So into 1 divided by 12. So to this extent also indirectly these guys are funding me. So the net current, the total current liability is going to be 67 lakh 8,333 and 1 crore and 50 lakh. So now your net working capital is going to be your total current assets minus your current liabilities. That makes it 7 crore 25 lakh 41,667. Clear with this, guys? Have the clarity with what you do. That's all. These are the figures we are dealing in, and now we have already done 3 parts. Clear with this, guys? Now let's move on to the 4th part of the question. Now, what are they asking in the 4th part? The annualized percentage costs of the 2 options for reducing the working capital. Now, what are they saying? Now, there are 2 options, right? One is by way of reducing your credit period. In the process, what is the cost that you will be incurring? Loss of profit, right? So what they are asking is, so whatever, let's say option A, what we are doing. So if you are going for option A, whatever you are losing, basically your costs divided by the funds that gets released because of that. Because if you do that, your funds gets released to some extent, right? But you lose out something, express this as a percentage and tell us how much is it, is what they are asking. Are you clear with this? So now let us do this. Now first what they are saying, 2 options are given. Option A is what? Reduce the credit period to the customers by 1 month, but this will lead to reduction in sales by 5%. Now look at this, what will happen? Now what will happen is, Presently, I'm giving my debtors a credit period of how much? 3 months. They are asking you reduce it to 2 months. If you do this, what will happen? In a year, your sales will drop by 5%. Currently, I am selling 3 lakh units, correct? Now, if I do this, what will be my revised number of units to be sold? 2 crore 85 lakhs, correct, guys? 2 crores 85 lakh. So, 2 lakh 85,000 units is what I will be able to sell in a particular year. Are you clear with this, guys? Yes. So now if I do this, so now my revised annual sales is going to be 2,85,000 units, right? And every time I sell a unit, what is the cost of sales for me? 750. So into 750. So technically speaking, my annual cost of sales, right, after coming up with this policy is going to be how much? 21 crore 37 lakh 50,000. Correct, guys? Now, in that, what am I doing? Out of this, 2 months equivalent of annual sales is going to be blocked in my debtors into 2 divided by 12. So now, if I introduce this policy, what will happen is 3 crore 56 lakh 25,000 will be the amount of debtors. Are you clear with this? This will be the revised amount of debtors. But if I have a 3-month credit period, what was originally the amount of debtors? Originally, the amount of debtors that I had to plan in my working capital was, look at this, 5 crore 62 lakh 50,000, right? If I had given a 3-month credit period, are you clear with this, right? So look at this. If I give a 3-month credit period, how much would have been my debtor value? 5 crore 62 lakh 50,000. If I now reduce it to just 2 months credit period, what will happen? Now my debtor, the amount of debtors that needs to be funded in my working capital is going to be 3 crore 56 lakh 25,000. So now clearly you can see, if I reduce my the credit period, now obviously the amount of working capital that gets blocked in my debtors gets reduced by how much? 5 crore 62 lakh 50,000 minus 3 crore 56 lakh 25,000. So now the amount released from debtors is going to be how much? 2 crore 6 lakh 25,000. So from my working capital, the amount gets released to the extent of 2 crore 6 lakh 25,000. Right, sir? This is good. No, sir. Wait, it comes with a cost. What is the cost? Now you have lost 15,000 units, correct? And each of these units would have generated how much amount of profit? It would have generated 250 rupees of profit. So now that is the cost for you, opportunity cost, obviously. So here 15,000 into 250, how much is it? 37 lakh 50,000 is going to be the cost. Now express the cost that you are incurring as in it includes opportunity cost. This cost expressed as a percentage of the fund that gets blocked, that gets released. Release of funds means what? Maybe reduction in the requirement of working capital. To this extent, I need not borrow. Are you clear with this? Right? How much is this? 37 lakh 50,000 divided by 206 25,000. That gives you how much? 18.18 percentage. This is the cost. This is the cost of what? This is the cost of reducing my debtors credit period. If I reduce my debtors credit period, no doubt I will be released. There will be some fund that gets released, but technically speaking, the cost that I am paying for this, paying as in not actually paying, the loss of profit expressed as a percentage of this is going to be 18.18%. Clear with this, guys? This is something new that they have asked for the first time in this RTP, right? This similar sum was not found in our in any of our institute's publication. This is something that they have done for the first time. But anyways, this is just an expression of the fund block. That's all. Nothing great. But in costing, if you see, I had told you there one entire sum itself was coined differently, like the perishable item and all. The first question that was class apart. But this relatively is fine because concepts are the same, but just that certain expression you just need to know. Fine. Now what happens if I go for a factoring? First he says, if I go for a factoring, flat, you need to pay him what? 2% of the invoice value you need to pay, right? Now, when I factor, what will I factor? Now, immediately you should know the concept of factoring. I will factor the debtors. Here it's not about the cost of sales and all that. Here it's going to be the debtor value. Now, what is the annual debtors? What is the annual debtors? Right, the annual debtor here is going to be how much? So the sales, annual sales is going to be 30 lakhs. Right? So at any given point of time, I will always be, having this debtors entirely is on credit sales. So on 30 lakhs, what is going to be 2%? So on 30 lakhs, 1 second. Yes, here we go. So on 30 lakhs, on 30 crores, how much is going to be 2%? That is going to be 60 lakhs. That is the commission amount, right? Then apart from that, right, how much is the interest he is charging? He says he will extend the 65% as the credit, correct? 65% of the overall debtor value will be given as a credit. Are you clear with this? So now how much is it going to be? So he says that 65%, right, 30 crores, that is the total annual sales. He's going to fund your entire sales, right? In a cycle, the debtor value will be less, but in a year overall, 30 crores is the sale that he's going to fund, right? Of that 65% is going to fund. He's going to charge us 12%, right? And it's only going to be for a period of 3 months. Per cycle, the cost is going to be 3 by 12. Why? Because at the end of third month, right, that guy will go and receive it from whom? He will go and receive it from the debtor. So technically, at any given point of time, he funds for a period of 3 months. And once again, after the 3 months gets over, fresh debtors will come in and life moves on like that. That is the beauty of working capital, which we have seen in our lectures. Clear with this, guys? So now what is the amount that is going to be per cycle? The interest is going to be how much? 58 lakh 50,000. Are you clear with this? So if I go for factoring, I will incur a commission of 60 lakhs. Right, I will be incurring 58 lakh 50,000 as interest per cycle. But wait, that is not all. If you go for this, now you need not have your own administration team. You need not be incurring bad debts and all. So 20 plus 16, 36 lakhs you can save every cycle. So this is the savings here. Are you clear with this? So technically speaking, what is the overall cost if I go for factoring? If I go for factoring, it's going to be 60 lakhs plus 58 lakh 50,000 minus 36 lakhs. So overall, the net cost of factoring is how much? 82 lakh 50,000. This is going to be the cost. Are you clear with this, guys? Are you clear with this? In one cycle, the extra cost that I will be incurring is how much? 82 lakh 50,000. But now, this is the cost I incur. Why am I incurring? Because that guy says 65% of whatever is the debtor value, he will just pay to me immediately. So what is the amount that gets released here? It is going to be 65% of my 30 crores. All the sales are on credit sales only. 65% of 30 crores is going to be 19 crore 50 lakhs. Are you clear with this? Are you clear with this? So what is going to be your net effective cost? 82 lakh 50,000 divided by the funds released 19 lakh 50,000. Wait, this is the cost pertaining to what? One cycle. One cycle. So one cycle is for a period of how much? 3 months. So now what will it be for 12 months? Into 12 by 3. The typical factoring calculation which we have seen in our regular lectures, that is what it is. No change here. Are you clear with this? Right? So 82 lakh 50,000 divided by, that is the net cost of factoring, divided by the funds released because of factoring. But that is for a period of 3 months. How much is it going to be for 1 year? You get a net effective cost of how much? 16.92%. Are you clear with this? So now the answer is going to be what? 18.18 and 16.92. 18.18 and 16.92. The answer is going to be option number A. The answer is going to be option number A, 18.18 and 16.92. Are you clear with this? Nothing, guys. Both the options are there. The cost incurred, net cost incurred in each of the options, I express that as a percentage of the funds blocked. Funds released. That's about it. Now let's move on to the next one. What will be the maximum permissible bank finance by the bank and the annualized percentage cost of the same? Now, how much amount will they be ready to pay us? How much amount will they be ready to fund us? Now, very simple. Net working capital is how much? 7 crore 25 lakh 41,667. On that 75% they are ready to give us as a loan, correct? 75% of 7 crore 25 lakh 41,667. So the cost is going, so the net maximum permissible bank finance, the bank will finance a maximum of 5 crore 44 lakhs 6,250. Now, what will be the annualized cost of loan? We just saw, he said at the time of reading itself, I told you, it's an independent question. At the time of reading itself, I told you, he said the interest rate is going to be 16.5%, but he came with a rider. Now, if I give you 100 rupees, out of that 100, 10 rupees you should always be maintaining with me as a current account. Technically speaking, he's only funding for 90% of that. So, for 90%, technically speaking, the amount that I receive from him is how much? He gives me 100. So whatever is that, 75% of working capital, right? Let us say that is a loan amount. He says that I will give you a loan amount of 100 rupees, correct? Right? But what he says is 16.5 rupees will be the, 16.5% will be the interest on how much? 100 rupees is what we think, but he comes with a condition at any given point of time, you should maintain 10 rupees with me. So technically, how much does he fund me? He funds me 100 minus 10. He funds me only 90. Are you clear with this? So 16.5 divided by 90 into 100. How much is that going to be? So how much is that going to be? So that is going to be 18.33%. That is going to be the annualized cost of bank loan. So now that is going to be your option number B. Are you clear with this? So that is about this particular numerical problem, right? One unique, certain unique aspects were there in this particular question, like especially the the fourth and the fifth part of the questions were slightly unique. So please watch out for this. The chances are it might be tested in your exam as well. Right, guys? Fine. With this, there's only one case study based MCQ in our RTP with respect to financial management, that is in working capital management. Now let's move on to MTP number 1. Now, the mock test paper number 1. Once again, I don't know for what reason, I think Institute likes to test working capital management in this, MCQ section. So yes, this is what they've asked once again. But this question, interestingly, is more to do with factoring, right? So now let's get started. NV Industries is a manufacturing industry which manages all its accounts receivable internally by its sales and credit department. It supplies small articles to different industries. The total sales ledger of the company stands at 200 lakh, of which 80% is credit sales. So the company has an annual total sales of 200 lakhs. Out of this 80%, 160 lakh is the total credit sale. The company has a credit policy of 2/40 net 120. What is the meaning of this? Now, generally, the customers need to pay within 120 days. However, if they pay within 40 days, they are eligible for a cash discount of 2%. We have seen all these things, right? Now, the past experience of the company has been that on an average, out of the total, 50% of the customers avail the discount and the balance receivables are collected on an average in 120 days, which means what are they saying? 50% of their customers pay within 40 days and avail the discount, right? Now, the balance 50% of the customers pay within 120 days and avail the discount. And the finance controller estimated that the bad debts losses are 1% of the credit sale. This is the present scenario. Right, guys? So 50% of the company's customers are paying within 40 days. 50% of the company's customers are paying within 120 days. On an average, what is the average collection period for the company? Right, on an average, what is the average collection period? So 0.5 into 40 plus 0.5 into 120, correct? That is going to be 80 days. Are you clear with this? Right, because one set of customers will pay within 40 days, one half of the customers will pay within 120 days. On an average, if I average out, I will say my collection period, my actual collection period is going to be what? 80 days on an average. That is 1 by 2 into 40 plus 1 by 2 into 120. Generally, representatively, if I want to put, I will say my collection period, data collection period is going to be 80 days. Clear with this, guys? Now, with escalating costs associated with in-house management of the debtors, coupled with the need to unburden the management with the task so as to focus on the sales promotion, the CFO is examining the possibility of outsourcing its factoring service for managing its receivables. Currently, the firm spends about 2,40,000 per annum to administer its credit sales, like what the phone calls, follow-up, recovery agent costs, and all these things. These are avoidable as a factoring firm is prepared to buy the firm's receivable. The main elements of the proposal are as follows. Number one, yes, they will charge a commission of 2% and it will pay an advance against receivables to the firm at an interest rate of 18%, but after withholding 10% as reserve. Clear with this? This is what they are saying, which means what? They will only release 90% of the debtor value, right? So this 10% is not a cost, right? However, this 10% is what? They will not fund you for that. They will only fund 90% of the receivable, but wait, after deducting for the commission and whatever is the interest. Now, also the company has option to take long-term loan at the rate of 15% interest, or may take a bank finance with the working capital at the rate of 14% interest. You were also present at the meeting. Being a financial consultant, the CFO has asked you to be ready with the following questions. So what are the questions they are asking? First, what is the average level of receivables? How much is the factor advance that will be paid against the receivable? Annual cost of factoring, net cost to the company on taking the factoring service, effective cost on factoring, and okay, that's all. Right? So the first part alone is average level of receivables. The other four are something to do with exclusive factoring question, 10 marks, guys. Right? Now, if you know how this works, we have actually done one numerical problem. I think one numerical problem we have done in factoring. Exactly the same they have only asked here. No, nothing great and all, no changes, much of changes. This is what it is. Now, let's get started quickly. Now, look at this. First, total sales is how much? 200 lakhs. Out of this, 80% credit sales is going to be 160 lakhs. Right? And out of this, 50% of my receivables, that is 80 lakh rupees, will be received within 40 days. I mean, 80 lakh worth of sales are received within 40 days, and the remaining 80 lakh rupees worth of sales are received within 120 days, which means the average collection period is what? So on an average, if I want to put it representatively, how long will it take? If someone asks me, what is the debtor collection period? On an average, it's going to be how much? 1 by 2 into 40 plus 1 by 2 into 120. So 1 by 2 into 40 plus 1 by 2 into 120. Why do I do this? Because half my debtors pay within 40 days and the remaining half pay within 120 days. So it's going to be on an average 80 days. So what is the average level of receivables? Very simple. In 1 year, what is the total credit sales? 160 lakhs, right? If that is for 360 days, they have asked us to take 360 days as the number of days in a year, right? I think that's what has been asked. Fine. Or they have, I think, that is what has been taken here. Yes. So they have assumed 360 days in a financial year, in a year. So if 160 lakh is the sales meant for 360 days, how much will be the sales worth for one working capital cycle. Working capital as in one collection cycle, 80 days. So 160 lakhs into 80 by 360. So at any given point of time, on an average, the receivables that I will be having is how much? At any day, if you prepare a balance sheet, day 1, day 2, day 3, any day you prepare, generally on my books, I will be having 35,55,556 as my average level of receivables. That's all. The first part of the question is over. So what is the average level of receivable? 35,55,556. Option B. Are you clear with this? Now, if I go to a factor, what happens? Now comes the factoring part. Guys, it's very simple. All the remaining four are interconnected to factoring. So it's very easy for us to answer. Now look at this, what happens here. The factoring commission is going to be how much? That guy is going to charge me 2%. Now what happens here is, right, in one cycle, what is he going to do? The amount that he is going to fund in a cycle is going to be how much? 35,55,556 into 2%. That brings it 71,111, right? And how much is going to be the factoring reserve? Will he give me the entire amount? No. Right? 10% of that he will withhold. So this amount he is going to keep it as a reserve. He will not fund me for that. So what is the amount available for advance? The total debtor value, right? Minus from that, he will withhold this amount, 3,55,556. It's not a cost for me, but he is not going to fund me to that extent. And number two, his commission he will deduct upfront. He will not wait for the end of that 80th day and all. Upfront itself he will deduct. Right? So this is the amount available for what? Advance. Clear with this? This is how we calculate what? This is how we calculate the factoring and all. This is how we calculate the amount that gets funded by the factor and all the associated costs. Now, he is going to fund me this amount. Are you clear with this? Right? He's going to fund me with this amount. So how much is that going to be? He's going to be charging me 18% interest on that. So this amount that he's going to fund me into 18%. So 18 by 100. Are you clear with this? Are you clear with this? Right? So this is going to be what? This is going to be for one cycle. Are you clear with this? Into 80 divided by 360. Right? This is the annual interest cost. Are you clear with this? This is my annual 18% is per annum. Are you clear with this? But one cycle's worth of funding is happening only for one cycle for a period of 80 days. So what is 80 days worth of interest? So it's going to be this amount that he is going to fund me into 18% into 80 upon 360. This is going to be the amount of interest. Are you clear with this? Now what will he do? He will deduct that interest also upfront. Are you clear with this? So now what will he do is 31,28,889 was the amount available for what? For funding. That is for, as an advance. From that, he will also reduce his interest, and this is the amount he will finally release you. So for a debtor worth of 35,55,556, today, how much will I get? I will get how much? 30,03,733. Inside this, what are all my costs? Two costs are there. One is going to be my commission. The other one is going to be my interest. So then what happens to this factoring reserve of 3,55,556 that he will pay after 80th day? Are you clear with this? That is not a cost for me. He says I withhold it. Are you clear with this? He says he will fund 90% of what? Of my debtors, right? After adjusting for his commission and interest. So this commission and interest alone is my cost. Are you clear with this, guys? So what is the next question they have asked here? How much advance the factor will pay against the receivables? He will pay 30,03,733. So this is option number C, 30,03,733. Are you clear with this? So this is the amount that he will be paying me today. Clear with this, guys? Now, what is the annual cost of factoring? We'll come to that. So now, what is going to be my annual cost of factoring? The factoring commission that we saw here, how much was it? 71,111. That is for one cycle of 80 days. So which means for a year, how much is it? So 71,111 into, so if this is for 80, so divided by 80 into 360. So in a year, what will be the total factoring commission? It's going to be 3,20,000. Similarly, the interest charges also, it is going to be 31,28,889, right? Into 18%, you can directly put it here. That is the annual cost. Or we had calculated here for 80 days. How much is it going to be for 1 year? So into 360 by 80, you can put, you'll get the annual interest charges. Are you clear with this? So this is going to be the annual cost of factoring, 8,83,200. Clear with this, guys? So it's going to be option number A, 8,83,200. Now wait, because I go for factoring, what happens? I also save some money. What is the money that I save? Two things I save. Number one, administration cost of 2,40,000. I told you that telecalling and recovery agent and all, I need not appoint now. So that amount I save. And there is also one bad debts that gets avoided. How much my bad debts currently? 1% on my annual sales. So 160 lakhs into 1%. So 1,60,000. This is also I save. So what is the total amount of savings that I get? 4 lakh rupees. Because I go to a factor, I need to incur extra 8,83,200. Parallelly, I save 4 lakh rupees. The net savings is going to be how much? 4,83,200. So the net cost of factoring is going to be 4,83,200. That was the next question. So it's going to be 4,83,200, option number D. Clear with this, guys? So what is going to be my effective cost of factoring? Whatever is my net cost, express it as a percentage of the amount that he is going to fund me. 30,03,733. So 4,83,200 divided by 30,03,733 into 100. So the effective cost of factoring is going to be 16.09%. Clear with this, guys? That is all they have asked for in this question, right? That is all they have asked for here. It's going to be 16.09, which is option number A. Right, this is going to be option number A. Clear with this, guys? And that is about this particular question. Now let's move on to the next question. Ramu Limited wants to implement a project for which 25 lakhs is required. The following financing options are at hand. So option number 1 is going to be equity shares, 25,000 at the rate of 100. So how much is that? So that's going to be 25 lakh rupees. So option 1, full all equity. Option 2, so 10,000 shares at the rate of 100. So 10 lakh from equity, 5,000 shares at the rate of 100, 5 lakh from preference, and 10,000 debentures at the rate of 100, another 10 lakh coming from your debt component. So here also the capital employed is going to be how much? Total capital is going to be 25 lakhs. So both the companies have the same amount of capital, only then they are comparable. Now what they are saying is, what is the indifference point and the EPS at that level of EBIT? Assume the corporate tax to be 35%. Very simple and a direct question. So what do you mean by an EBIT EPS indifference point? It is the point of EBIT where the EPS under two alternatives are the same. So how will you calculate that? Keep your EBIT as X and you do it, you will get the answer. It's fairly a simple direct calculation. Now look at this. So this is how you calculate EBIT minus interest, right? This gives you what? EBT, right? Into 1 minus T gives you what? EAT, minus preference dividend gives you what? Earnings available to equity shareholders, right? That divided by the number of equity shares gives you the EPS under alternative 1. That's why N1 they have given, number of shares in alternative 1. Similar thing you need to do for alternative 2, divided by the number of equity shares in alternative 2, you get the EPS under alternative 2. So now the point of EBIT where both the EPS are the same is going to be called as an indifference point. Now let's keep that as X. In alternative 1, what is the interest? 0. It's an all equity unlevered entity, right? Into 1 minus 0.35 minus, there is no preference dividend, divided by what is the number of equity shares here? What's the number of equity shares? You got 25,000. So let's put it up here, 25,000. This should be equal to, so option 2's EPS, how will you calculate? X minus, so what is the interest that you will calculate here? So it's going to be 10 lakh into 10%, 1 lakh, correct? Into 1 minus 0.35, so it's going to be 0.65, minus a preference dividend. How much is preference dividend? 12% on 5 lakh, that's going to give you 60,000 rupees. So minus 60,000. The whole divided by how much? The number of equity shares here, it's going to be 10,000. Are you clear with this? So you equate the two, right, and solve for it. You will get the X value, EBIT, as 3,20,513. So what does it mean? So when my EBIT is equal to 3,20,513, so now both the alternatives will exactly give me the same EPS. Now how much will be the EPS? Take any one alternative and substitute EBIT or substitute the X value as 3,20,513 and see. So now let's take alternative 1. So it's going to be 3,20,513 minus 0 into what? Into 1 minus 0.35 into 0.65 divided by 25,000. How much you get your EPS as? 8.3333. So the EPS at the indifference point of 3,20,513 is 8.33 rupees per share. So now let's go and figure out where this, which option is this? Which option is this? Yes, it's going to be option number B. 3,20,513. That's the indifference point of EBIT, and the EPS at that level is going to be 8.33. Pretty much simple and straightforward, right? Now moving on to the next question. So question number 3, if EBIT increases by 6%, net profit increases by 6.9. So what do you mean by net profit? Net profit is nothing but your earnings after tax, right? If there is no preference dividend, then this is also nothing but earnings available for equity shareholders, EFE, right? It increases by 6.9. Now, if the sales increase by 6%, the net profit will increase by 24%. Okay. Your financial leverage must be how much? Now, forget all this. What is financial leverage? Logically think percentage change in EPS divided by percentage change in EBIT. Correct, guys? Now, percentage change in EPS. Your EPS will move only if there is a movement in your earnings for equity. In this case, net profit, right? Or in other words, can I say this percentage change in EPS is exactly equal to the percentage change in your net profit, earnings for equity. Only if your earnings for equity increase, there will be an increase in your EPS, because EPS is nothing but earnings for equity divided by number of shares. My number of shares will not be changing. So if at all there is an increase in my EPS, that is only purely because of my increase in my earnings for equity, right? So this is nothing but percentage change in earnings for equity. In this case, they call it as net profit divided by percentage change in EBIT, right? So tell me, guys, how much is that? Percentage change in EBIT is in EFE, the net profit is going to be 6.9%. And how much is the percentage change in EBIT? That's going to be 6%. So 6.9 divided by 6, how much is this? 1.15. Answer is option number D. That's all, guys. Nothing great here, right? You just need to have some presence of mind. You need to know that the percentage change in EPS, my EPS will move purely because of the movement in my net profit. Are you clear with this, right? If you know this, automatically you'll be able to crack it. And that's all it is, guys. That's about it. Fine, guys. That's about it, right? So let's once again, let's just check this up. Yes, it's going to be percentage change in net profit divided by percentage change in EBIT, 6.9 upon 6. It's going to be 1.15. And the answer is option number D. Are you clear with this, guys? As simple as that. So the next one is going to be a pure theory question. What is the maximum what is the maximum period for which a company can accept public deposits? So it's going to be 3 years, right? So the answer is going to be 3 years, right? This is something that is there in your theory chapter, types of financing. Right, the minimum period is 6 months, maximum period is 3 years, right? It's a pure and direct theory question, so it's going to be option number C. It carries a weightage of 1 mark. Are you clear with this, right? So with this, we have finished the mock test paper series number 1. So now let's move on to mock test paper number 2. Now going on to the mock test paper 2, right? The first question. Tiago Limited is an all equity company engaged in the manufacture of batteries for EVs, electric vehicles, right? So by the way, Tiago, it's one of the name of the car, of Tata Motors, right? Tiago. Now there has been a surge in the demand for their products due to rising oil prices. The company was established 5 years ago with an initial capital of 10 lakh rupees, and since then it has raised funds by IPO, taking a total paid up capital to 1 crore rupees, comprising of 1 crore comprising of fully paid up equity shares of face value of 10 each. Now they have just given a history of the company, which is not much of relevance here. This 10 lakh and all is not relevant. When they started with 10 lakh. As on date, the total paid up share capital is going to be 1 crore rupees, made up of what? 10 lakh shares, the rate of 10 each. That is the breakup that they've given. The company currently has undistributed reserves of how much? 60 lakh. So that is also there in the company. So 100 lakh is the equity share capital, right? And they have reserves, retained earnings of how much? 60 lakh. This is the company. This is what the company has as on date. The company has been following a constant dividend payout policy of 40% of retained earnings. Means what? The dividend payout ratio. The DP ratio is going to be how much? 40%. Then the retained earnings with the company are going to provide a return on equity of 20%. Now remember, so now the return on equity is going to be how much? So that's going to be 20%. So now immediately what should strike you? G is equal to BR, the growth rate, that should strike you. So B is nothing but your retention ratio. Retention ratio is how much? If payout is 40, retention is 60. So 60% into 20%. So 0.6 of 20%, 12% is the growth rate, right? G is equal to BR formula. Anyways, let's do this. Fine. The current EPS is estimated as rupees 20. Currently EPS is 20. The prevailing P ratio on the share of the company is 15x, 15 times. Clear with this? P ratio is 15. Right? So how much will be the share price? So P ratio means what? Market price divided by earnings, right, is equal to 20. Is equal to 15. This is what they have given. EPS is 20. They have given. Market price currently is how much? 20 into 15. That's going to be 300 rupees. Clear with this? All these things should immediately strike you. The company wants to expand the capital base by raising additional funds by way of debt, preference, and equity. Three sources of additional finance they want to raise. The company requires an additional funding of 120 lakhs, so 1 crore 20 lakhs. The target ratio of the owned to borrowed funds is going to be 4:1 post the fundraising activity. The company, the capital gearing ratio is to be kept at 0.4x, 0.4 times. X stands for 0.4 times. Clear with this? So what do you mean by a capital gearing ratio? Outsiders funds divided by insiders funds. That is preference plus debt divided by equity component. Clear with this, right? They have given some ratios. Based on this, you should be able to figure out how much they are going to take from which source of finance. Next. The existing debt markets are under pressure due to ongoing RBI action on NPAs of commercial banks, something they have given. Due to challenges in raising the debt funds, the company will have to offer rupees 100 face value debentures at an attractive yield of 9.5% and a coupon rate of 8% to the investors. Right? The issue expenses will amount to 4% of the net proceeds. This is about what? The new debentures that they're going to raise. Next, the preference shares will have a face value of 1,000 rupees, each offering a dividend rate of 10%. The preference shares will be issued at a premium of 5%, redeemed at a premium of what? 10%. So it will be issue price will be how much? 10%, it's going to be issued at a premium of 5%. So 5% means what? 5% on 1000 is going to be 1050. Whereas the redemption value is going to be how much? Redemption value is going to be 10% premium, 1100 rupees. Clear with this, right? And they will be redeemed at the end of 10 years. At the same time, when the debentures will be redeemed. Okay, so now the life of the debentures is also going to be 10 years. Are you clear with this? This is what they have mentioned. Here also the life is going to be 10 years. Right? This is finite only, not infinite. Next. The CFO of the company is evaluating a new battery technology to invest the above raised money. The technology is expected to have a life of 7 years. This is on the investment side. He's saying it will generate an after-tax marginal operating cash flow of rupees 25 lakhs per annum. Assume the marginal tax rate to be what? Tax rate to be 27%. We need to answer the following question. First, let us run through what are the questions that are being asked here. First, calculate the cost of equity, right? And which of the following is the most accurate measure of the issue price of debentures? They are asking you to calculate that. Then, what is the best estimate of the cost of debentures using approximation method? They are asking for KD calculation, shortcut formula, KP calculation, shortcut formula. Which of the following best represent the overall marginal cost of capital? This is also being asked, right? These are the 5 legs of this particular question, right, guys? Fine. So pretty much straightforward. I don't see much of difficulty in this question. Pretty much straightforward and kind of similar to what we have done in our lectures, in our regular lectures. Clear with this? Now let's get started. So first, what have they asked? First, what have they asked was the first question. They are asking us to calculate cost of equity. Now, cost of equity, there are a lot of different formulas of ways in which you can arrive. Clearly in this question, they are indicating what? They are indicating dividend growth rate model. Sir, how do you know, sir? Yes, they have given DP ratio. Immediately, they have given return on equity and all. So, G is equal to BR. With that, you calculate the growth rate, right? Present year dividend is given. Next year dividend can be found out. So, K is equal to D1 divided by P0 plus G, right? That Gordon's formula, dividend growth rate model, needs to be used here. So don't use any other model, right? Because you can also use certain other models like, they have given the PE ratio. I told you 1 divided by PE ratio is also KE only, right? Fine. So based on the wordings, you should know which formula needs to be used. This is a clear-cut example of what? Dividend growth rate model. If you use any other formula, they will not give you marks. Clear with this, guys? So now let's get started here. So first, what is the retention ratio? So dividend payout ratio is 40%, retention ratio is 60%. What is the return on equity? 20%. So now what is going to be my growth rate? What is going to be my growth rate? The growth rate is going to be G is equal to B into R. B stands for retention ratio, 0.6. R stands for return on equity, right? 20%. So G is equal to how much? 12%. Clear with this, guys? Now currently or the last year, what was the dividend paid? They said that the EPS was 20 rupees and the payout ratio is 40%. So now 22.4, it's going to be 8 rupees was D0, the dividend paid in the last year. Are you clear with this, right? So what will be the dividend to be paid in the next year? So D0 into 1 plus D into 1.12. The next year D1 is going to be how much? 8.96. So now in this formula, what do we need? KE is equal to D1 divided by P0 plus G. Do you have D1? Yes, it's 8.96. Do you have G? It's 12%. PO stands for what? The current market price or the issue price. Yes, in this case, can you calculate the market price? Yes. EPS is given, P ratio is given. So P ratio into EPS, EPS into PE ratio. So that gives you what? That gives you your market price per share. Yes, I just told you it's 300 rupees, right? This component is also there. Now just substitute and arrive at KE. How much is that going to be? So 8.96 divided by 300 plus 0.12 is going to be how much? 14.99 percentage. Are you clear with this, guys? So 14.99 percentage is going to be your KE calculation. That's going to be option number D. As simple as that. Clear with this, guys? Very simple. 2 marks done. Next, what is the most accurate measure of issue price of debentures? Now, issue price of debentures, how will you calculate? Read this. Some existing debt market pressure, forget all these things. Now, due to challenges, the company will have to offer this 100 rupees face value debentures at an attractive yield of 9.5%. So now immediately switch the sides. Look at this from the perspective of the investor. How much is the maximum amount he will be ready to pay to purchase these debentures? He says, look, every year I will be getting 8 rupees as my interest, correct? And at the end of the year, at the end of 10 years life, I will be getting back how much? The face value, 100 rupees, right? So now what will be the maximum amount that he will be interested in investing? Like what will be the maximum amount he will be interested in purchasing the debentures? So it is going to be the present value of all the future benefits he is going to receive, present value of all the cash flows that he is going to receive, investor's perspective. Clear with this? So it's going to be 8 rupees every year he is going to receive into present value interest factor annuity of 9.5%. That is the yield he is expecting for 10 years plus 100 rupees into present value interest factor of what? 9.5% for 10 years. Are you clear with this? You need to do this. You arrive that present value is going to be your issue price. Are you clear with this, guys? Now, this 4% flotation cost is not at all considered for the purpose of calculating the issue price. That is calculated for the purpose of calculating net proceeds. That is KD calculation from the viewpoint of company. Here they are just asking you the amount to be, what is going to be the issue price at which the debentures are going to be issued. Clear with this, guys? Now, look at this. Price of the debentures is equal to present value of all the future cash flow for the investor discounted at their yield. Every year they will be receiving 8 rupees. So present value annuity factor 9.5% into 10 years. Guys, you know how to calculate the present value table and all. Generally, it will be given. In this case, it's not given. Even then, you can do it. So 1 divided by 1.095 you do. So is equal to, you just keep on getting it. Use M plus and all. So you to accumulate, you will get the annuity table by yourself. It's very simple, right? Fine. Then now, plus apart from that, at the end of the period, you get 100 rupees. That's present value factor into 9.5% for 10 years. That's going to be another thing. So you do this, arrive at the present value, you get what? 90.58 rupees. That needs to be the issue price. Are you clear with this? So 90.58 rupees, that's going to be option number C, right? That's all. Next, they are asking for KD calculation. So what is going to be your KD calculation now? So using the shortcut formula method, guys, come on, tell me what's the formula for calculating KD, right? Logically think, should you mug up? Not even a single formula needs to be mugged up in FM and costing, right? I told you my commitment. So please, guys, now is the time for you to actually recollect all of that. So now tell me, so what is it going to be? What is the formula going to be for cost of debentures? Now, KD calculation using the approximation method. So how is it? I interest into 1 minus T. So this is the net interest cost. Is that the only cost? No. Plus RV minus NP, right? So the difference between that is the cost incurred over a period of the life divided by N. This is the annualized cost divided by, take the capital amount. How much is the capital? I have two capitals here, RV, and I also have NP. Take a simple average of that divided by 2. Clear with this? Conceptually, I thought, yes, you can just know this. We've learned this conceptually. So yes, we can actually now use this formula. Clear with this, guys? This is what they have given. Now, interest into 1 minus T, 8 into 1 minus 0.27, right? Plus RV redemption value is going to be what? That is going to be the same 100 rupees minus NP. How much is going to be my net proceeds? Now, for the purpose of KD, you should consider what the flotation cost. They have given that the flotation cost is going to be 4% of the net proceeds. So now they have clearly given that it's going to be how much? 4% of the proceeds. Clear with this? So which means it's going to be 96% of the issue price. So that is going to be 86.96. This is the amount that I'm going to receive net of, right? That's going to be my net proceeds divided by 10, the whole divided by 100 plus 86.96 divided by 2. Use this formula, you will directly get 7.64. Are you clear with this, guys? So 7.64 is what option? It is option number A, right? 7.64 is option number A. Clear with this, guys. Next, what is the cost of preference shares? Same story. Here you have what? Instead of interest into 1 minus T, you have preference dividend. So KP is equal to preference dividend plus RV minus NP divided by N, the whole divided by RV plus NP divided by 2. Clear with this, guys, right? All these things are pretty much simple and straightforward. So now what do you do here? Go up. So now, what's the preference dividend? The preference dividend is going to be 10%, right? They've said it's 10%. So preference dividend is 100 into 1 minus T will not be there because preference dividend is not a tax deductible expense. Plus RV, how much is the redemption value? It's redeemed at a premium of 10%, so it's 1100 minus net proceeds. How much is it? Issued at a premium of 5%, so 5% on 1000 is going to be 50, so 1050. There are no flotation costs here. Divided by life is 10, the whole divided by 1100 plus 1050 divided by 2. So you get how much? You get 9.77 rupees as the effective KP. Are you clear with this? So that's going to be option number D. Next, they are asking for the final part. That's going to be marginal cost of capital, which needs to be computed. So now, marginal cost of capital. Now, how will you compute? For me to do this, I need to know how much amount of funds are raised from which sources of finance. Now, they have not directly given, but they have just dropped a few hints here using which we need to compute. Now, how do you do this? Simple. Presently, what is the company having? 1 crore rupees worth of equity share capital plus 60 lakh rupees worth of retained earnings. Presently, the funds they have is 160 lakh. This is all the company has right now. Clear. Now, what they are saying, they want an additional fund of how much? Additional fund of, they want an additional fund of 1 crore and 20 lakh. Clear with this, guys. So, after raising this 1 crore 20 lakh, what will be the revised total capital employed for the company? It will be 1.6 crores plus 1.2 crores, 2.8 crores. Clear with this? No issues here? Fine. Now, sir, how much is going to be the amount that I'm going to raise? Wait. Now, they have a few requirements here. What have they said? Look at this. Now, the company wants to keep its capital gearing ratio as 0.4. 0.4 x means 0.4 times. Or in other words, what they are saying is, after issuing it, right, this is not the additional amount. This is the scenario after raising the additional funds. What they are saying is, preference plus debentures mode divided by equity. This is the capital gearing ratio, should be equal to 0.40. That is outsiders funds. For the sake of this ratio, right, the outsiders funds include what? Include preference shares also. Clear with this? At the end of the day, they are also outsiders, true outsiders, right? The true insiders are only the equity shareholders. Now, so preference plus dividend, preference plus debenture, can I say is nothing but 2.8 crores minus the equity component will be the total of preference plus debentures, correct? Now, this breakup, I don't know. This is what we are trying to find out. So, can I say is nothing but 2.8 crores minus equity, the whole divided by equity is equal to 0.40. Correct, guys? So now the only variable in this equation is equity. With that, I can find out what should be my total equity component. By equity, I mean equity share capital plus retained earnings. What should be my total equity component after raising the additional funds? Are you clear with this? So now what do you do here? 2.8 crores. So now this E goes to the other side. So how does this equation become? 2.8 crores minus E is equal to 0.4 E, or here 2.8 crores is equal to, so it goes to the other side, it becomes E plus 0.4 E is 1.4 E, or E is equal to 2.8 crores divided by 1.4. So 2.8 crores divided by 1.4 gives you how much? That gives it 2 crores. So after raising the additional funds, the equity component should be having a total value of how much? 2 crores. Are you clear with this? This way we found out how much is the equity component. Still, I need to know what should be the breakup of preference and debt. How will I find out? Now look at this. Here they have said use this ratio. The target ratio of owned to borrowed funds should be 4:1. Meaning what? Here the owned funds include equity and preference. Clear with this? This is the beauty of ratio analysis, right? So now here the borrowed funds at max can be what? 1/5 of the total capital employed. Right here, after raising the additional funds, what is the total capital employed? 2.8 crores. So now what happens? 2 crore 80 lakhs, right? 2 crore 80 lakhs into 1 by 5. How much is this? 56 lakh. So the maximum debt component can be 56 lakhs. Are you clear with this, guys? Are you clear with this? So now what happens? I have this figure already. Now I have found out this figure also. How did I find this out? It's going to be 1 by 5 into 2.8 crores. Correct? So this is going to be my balancing figure. Are you clear with this, guys? Right? So now with this, we have found out what is going to be my capital structure after raising the additional finance. Now let us find out how much is the additional funding. What is the additional amount coming from which source? So before raising the funds, equity balance was 1.6 crores. After it's become what? 2 crores, which means 40 lakhs is coming from the equity channel. Preference 24 lakhs, entire 24 lakhs, debt entire 56 lakh. If you add up, this 1.2 crores additional funds are being raised through these three modes in this proportion. Are you clear with this? This is the first step of doing this particular problem. We have not yet done it. We have not yet completed, right? So that's the reason why I'm saying this sum is like, ideally this particular component should have been tested for 4 marks because this is quite comprehensive. But all these things you need not present it in the paper. Don't worry about it because it's just an MCQ. They want the final answer. That's all. Clear with this? Now, how do you arrive at the marginal cost of capital? Very simple. So now you have these marginal cost of capital means what? The cost, weighted average cost of capital pertaining to the additional extra amount that you've raised. So what is the extra amount you've raised? 1.2 crores. This is the ratio. So these are the weights. Now you have the respective costs. KE is 14.99, we already calculated. KP is 9.77, we already calculated. KD is 7.64, we calculated. Multiply the cost with the respective weights, you get your weighted average cost of capital pertaining to the additional source of finance. That is nothing but my marginal cost of capital. That is going to be 10.52%. That's the final answer, and that is your option number A, which is 10.52. Clear with this, guys? Clear with this, guys? Right? See how beautiful the sum is, and the entire sum comes from what? The chapter called cost of capital. 10 marks. 10 marks out of the 15 mark MCQ. 10 mark in this mock test paper they had tested from cost of capital. If you look at this in the previous mock test paper series 1, the 10 mark component came from where? That came from your this one. What do you call this? Working capital management. Sorry, I don't know what happened. So yes, weighted your working capital management. Even in RTP it came from working capital management. Here it's come from what? Your cost of capital chapter. Clear with this, guys? Now let's quickly move on to the remaining sums, remaining MCQs. Now the next question. Ranu and Company has issued 10% debentures of face value 100 rupees for rupees 10 lakhs. The debenture is expected to be sold at a 5% discount, and it will also involve a flotation cost of rupees 10 per debenture. The debentures are redeemable at a premium of 10% after 10 years, and calculate the cost of debentures if the tax rate is 30%. Now guys, direct formula substitution. So now in this case, what's going to be your interest? Interest is going to be, in terms of amount, the interest is going to be 10% on 100. It's going to be how much? 10 rupees. Right? So 10 into 1 minus t, what's my tax rate? So 1 minus 0.3 plus RV, redemption value. How much is going to be my redemption value? The redemption value redeemable at a premium of 10%. So 110, right? Minus, just a minute. 1 second. So here it's going to be 110. That's going to be my redemption value. Minus, what's going to be my net proceeds today? Sold at a discount of 5%, so 100 minus 5, 95. But there is a further flotation cost of 10. So further minus 10, that's going to be 85. Right? Divided by what? Divided by the number of life, useful life, 10. The whole divided by 110 plus 85 divided by 2. Clear with this? If you do this, you will be getting the final answer. Right? That's what they have done here also. So 10 into 0.7, that is 1 minus 0.3 plus 110 minus 85 upon 10, the whole divided by 110 plus 85 divided by 2. 110 plus 85 by 2 is 195 by 2. That's why it's 97.5. Clear with this? You do this, you get a final answer of 9.74%, which is option number A. That's all, guys. Nothing great here. Now let's move on to the next one. The sales is 10 lakhs. The break-even sales is 6 lakhs. Calculate the degree of operating leverage. Now. Come on. So now break-even sales is given, which means what is my margin of safety? Margin of safety is going to be 4 lakh. So margin of safety expressed as a percentage of total sales is how much? So margin of safety in percentage is going to be how much? That's going to be 40%. Now operating leverage is equal to 1 divided by margin of safety expressed as a percentage. We have seen the logical derivation for this also. So now you should bring that presence of mind here. It's going to be 1 divided by 0.4. How much is that? That's going to be 2.5. The final answer is option number C. That's all, guys. See, direct MCQs are very, very simple. You can directly get this. Clear with this, guys? I think this is a book back, MCQ that we have done. So it's going to be 2.5. So how they have done it? 1 divided by margin of safety expressed as a percentage, 2.5. Finally, let's move on to the last one. A project requires an initial investment of 20,000 and it would give an annual cash inflow of rupees 4,000. The useful life of the project is estimated to be 10 years. What is the payback reciprocal, not payback period, payback reciprocal, or the approximated IRR as they call it. Now, IRR approximation is just, an eyewash. They are just mentioning it as an approximate IRR. But anyways, it's ideally called as payback reciprocal because IRR cannot be estimated properly. First of all, we saw that there is no formula for calculating IRR only, right? It only happens on trial and error basis. Fine. But in real life, you have a lot of algorithms to calculate IRR, but that apart. Now, coming back here. So what is the payback reciprocal? How will you calculate that? Look at this: average annual cash inflow divided by initial investment into 100. So it's going to be 4,000 divided by 20,000 into 100. That's going to be 20%. So 20% is option number A. Are you clear with this, guys? Right? That is all about the MCQs, the comprehensive, the case study based MCQs pertaining to financial management that are there in these 3 sources. That is revision test paper, mock test paper number 1 and mock test paper number 2, right? These are the 3 sources where you can actually find the resources given by the institute in terms of your case study based MCQs, and we have covered it all in complete detail. Clear with this, guys? So now this is ideally a must watch video before you enter into the exam hall, right? So please do share this with your friends, not for the sake of anything else. The only reason behind this is there are students who might not know that these RTPs and MTPs have some quality questions. They might be thinking that this is just like any other attempt. Generally MTP and all, I don't generally discuss on our channels, or generally we don't discuss MTPs because the standard of MTPs till date are all like they just pick questions from the study material and leave it. But this attempt, the quality of MTP has been a class apart. There has been a lot of changes in the way in which MTP has been coined or designed in this particular attempt. That's the reason why I'm doing this. Yes, and the descriptive portion, anyways, we have covered it in depth in our lectures. That is more than enough. But I just wanted to give you guys an idea as to how the case study based MCQs are getting tested, right? So these 3 sources are a must visit before you appear for your exam for sure. Clear with this? This will guarantee 15 marks in your pocket. At least you will be prepared as to the kind of questions, the manner in which they are being tested in the exam. Clear with this, guys, right? So have all the confidence and you guys are going to make it really well in your exam. And this being your last exam, that is your paper 6 as being your last exam. So work hard right now and party harder. Clear with this, guys? So on that note, I'm signing off in this video. I will see you all in the next one. Thank you all so much. Have a great day ahead.